As we look at our what we call our yield impact model, that's a relationship between where bonds become attractive relative to the earnings yield of equities. It's not the Fed model, by the way. But when we look at that, where yields are, and what that historically says, we're in that 90th, 100th percentile, which is essentially flat performance for equities and outperformance from bonds. So at this point, you do start looking from an asset allocation standpoint at bonds offering a more attractive outcome than equities, at least in the near term. Welcome to RenMac Off Script. We're able to discuss markets, economics, policy, history, and life. It's the 10th of January, 2025. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We're going to hit on, obviously, the employment report, the upcoming nominations, some of the salvos thrown out at the press conference this week, and we'll talk about the markets and the market's reaction to what we're seeing from these yields. But hot off the press, Neil, we've got the payroll data. Obviously, it was firm, almost confoundingly firm. What do you make of it as you've gone through it?
Well, I mean, it was a strong headline jobs number. There's no doubt about that. You have to take the numbers as they come to you. I mean, 256,000, given how low the unemployment rate is a remarkably strong number. Okay. I think what you could say is that, at a minimum, labor market conditions have stabilized, right? Like, so we were slowing into August and we've stabilized since. If you look at the 3-month average on total payrolls, it's running 170,000 over the last 3 months. I mean, that's basically moving sideways. So I think that's good. So I think growth has stabilized. If you had to pick an area of concern, I would just say that cyclical areas of the labor market don't look great. So if you look at goods producing jobs as an example, they've been declining for 2 of the last 3 months. The manufacturing hours worked has been down for 3 of the last 4 months. So you should expect to see another drop in manufacturing production in December. If you look at the market's response to the data, obviously the Fed is not in a forgiving mood, right? I mean, the big difference now relative to September when they did the 50 basis point cut was they're more concerned about inflation than they are about employment. Okay, and so markets are responding in kind, right? So strong jobs number is going to push yields up a lot higher. Then a weak jobs number would have pushed yields down. And you're seeing that right now in the financial markets. So this ongoing increase in longer term interest rates that we're seeing, I think that's going to weigh on housing activity, in my opinion, and kind of exacerbate the affordability issues. We've already started to see real estate services employment decline. So I wonder, how long construction employment will keep up. But this is just another reminder that that goods producing employment, cyclical areas of the labor market are not looking great at the moment. So the markets right now are showing a broad tightening of financial conditions. I think we're only pricing in 1 more rate cut this year, so it's getting pushed back to the back half of 2025. We'll see. I mean, I was interested to see some comments from the St. Louis Fed president talking about how financial conditions are still supporting growth. I'm not so sure. I think financial conditions aren't really supporting growth anymore, and we're going to find out very quickly who's right about that. So I do think that there's still a prospect for an about face here from the Fed. I don't really buy the idea that the labor markets are accelerating. I think firms are kind of in a wait and see approach with the new administration, and we'll see if that's right. I do think there's a lot to not like about the outlook between housing, state and local government finances, and capex that's not AI related. And I don't think what we have is a very imbalanced economy. Certainly an economy that's growing. I mean, no one's talking about recession here, but this is not a balanced economy. And I think that'll show up more in the data, in the coming year.
Is there anything historically quirky about the December payrolls that can throw it off? I mean, it's a big number, so it's going to be hard to offset
I
that.
mean,
But
you could. I mean, I think that most you could say is that maybe this is like sort of the residual rebound from like hurricanes and things of that nature. So maybe you have some follow through on that. But again, I mean, like I said, I think financial conditions are broadly still tightening, and unless you think neutral rates are much, much higher, it's hard to see, the economy just powering through. I mean, certainly you're already seeing mortgage purchase demand has, dropped. I mean, we see that, right? Private sector borrowing rates remain elevated. The fact that the dollar is continuing to rise, I mean, I think it's hitting a fresh high this morning. Do you think that U.S. export growth will not respond? I mean,
right.
it's interesting. So we're going to see. But I think to me, the tightening of financial conditions that we're seeing is, I mean, it's gonna slow the economy down, I think.
Well, it's definitely, compartmentalized, right? You can see it in home building. You can see it in the performance of home building stocks. You can see it in building materials. You can see it in construction materials or building products. You can see it as, you kind of go down that list of what you'd expect to see impacted the hardest first. And so having an impact on REITs, obviously. So there's definitely a knock-on effect. And as we look at our what we call our yield impact model, that's a relationship between where bonds become attractive relative to the earnings yield of equities. It's not the Fed model, by the way. But when we look at that, where yields are and what that historically says, we're in that 90th, 100th percentile, which is essentially flat performance for equities and outperformance from bonds. So, at this point, you do start looking from an asset allocation standpoint at bonds offering a more attractive outcome than equities, at least in the near term. We'll hit on some triple B spreads and some of these other things as we go, but let's get to you, Steve. A lot of red meat this week. We have Greenland as the 51st state, or is that going to be the 52nd state after Canada? Which one makes it first? And then the Gulf of America. I mean, take your pick. I mean, just pulling the pins out of the grenade and rolling them into the press corps one by
Tour
one.
de force, tour de force.
It's
I
unbelievable.
mean, let's just, I mean, can we even, as a matter of pop culture, I don't know who watches The Breakfast Club. I think it's on Hot 97. Charlemagne the God. But he had an interesting kind of quip this week where he basically, and this is no Trump supporter, by the way, he basically said, Donald Trump has shown me what's politically possible. And I encourage everyone just to go and take a look at it. I mean, the fact that we're even talking about these things, whether you think it's, I mean, is kind of shifted the conversation in a way, right? I mean, it's sort of thinking big, relative to his political adversaries. And, it's kind of changing, I think, some of the psychology out there. So I definitely encourage everyone to go take a look at that. Charlemagne the God, Breakfast Club, talking about what's politically possible, thanks to President-elect Trump.
5 stars from Neil Dunn. There you go. Money back guarantee. All right, Steve, floor is yours. What's going on in DC, or what's not going on in DC? Maybe that's more interesting.
Well, I guess I'll hit both of those for you. With the Trump press conference, look, I think it's just a reminder we can return to Trump. We can return to a lot of policy uncertainty, headline risk. There are both risk and opportunities there for people trying to invest and trade in that space. And I think when I think of Trump's territorial aspirations as they were stated, like everything's in negotiation for him. I think the through line I see is China. We've talked about his concerns over the Panama Canal, concerns that China has an overly large influence in an area that's so close to the U.S. For Canada and the political situation there, I think Trump's recognized his weakness. I think that's why he's pushing on Trudeau to announce his resignation. I don't know that Trump necessarily caused it, but it didn't hurt in terms of sentiment against him. And when you think of Canada, there's a lot of resource-rich area. And I think that's going to be important when you talk about critical minerals. That's one of the choke points that China has, a potential retaliation when Trump starts to pivot there. And then you think about Greenland. Greenland sort of both. It has a lot of resources, and it also, in terms of the Arctic routes, attractive area for shipping lanes, and that's concerned with China and Russia, their aspirations there. So that's sort of how I see all three. I guess what I'm sort of wondering is this sequencing here. We talk about tariffs. Last time looked like Trump really focused more on securing negotiations with the bordering countries, Mexico and Canada, before really going ahead and pivoting more aggressively to China. It seemed to me that he was thinking of trying to do that this time. Makes sense. Mexico concerned about the circumvention. China basically just assembling goods there to evade U.S. trade restrictions. And then Canada, again, the resources are important and the critical minerals. So it hurts China's negotiating leverage. So that's sort of how I'm thinking about that. And then what's not happening right now, Republicans don't have a plan as to how to proceed with Trump's agenda. It's sort of the Trump two-step on the one reconciliation bill approach. He initially endorsed it. That's sort of saying, leave it up to you guys to decide. The Senate's proceeding with the two-bill strategy. House Republicans pursuing a one-bill strategy. I think this is important. One, it's going to decide when that tax package is going to come together. I know that's of interest to everybody who pays taxes, even probably to some who don't. But also on the debt limit. Speaker Johnson's talked about addressing the debt limit with this one reconciliation bill. I'm skeptical that we're going to have the near unanimity needed in order to do that in the House. And that's important because of the timing here. Johnson talked about getting it to President Trump's desk by Memorial Day, the end of May. And if that effort fails, with respect to addressing the debt limit there, then you have to pivot to getting Democrats on board, sort of a bipartisan bill. They're going to demand a lot of concessions in order to do that. And at that point, we're a lot closer to that X date when the risk of default becomes clear. So I think that's sort of how, if I can put it all together, that's why I think that's really important.
And we've got confirmation hearings next week. Is that right?
Yeah, so when you ask about the week ahead, I think that's going to be the thing to watch next week. I believe it's been announced now that Trump's nominee for Treasury Secretary, Scott Bessent, is going to go Thursday. I don't think his confirmation is in jeopardy. I think it's an opportunity to hear from the nominees directly as to their thoughts on major matters. I'm sure he's going to get asked about a lot of things under Treasury's jurisdiction. So I think it's definitely viewing material for Thursday. And you're going to have a lot of nominees next week for the Trump administration. And I think that's done deliberately, try to flood the zone, make it harder for your political opponents to attack. So we could see a lot of headlines coming out there. I don't believe RFK Jr. is scheduled for next week. I think when that happens, that's somebody to watch, because ordinarily, if you get to the confirmation hearing stage, it probably means that you likely have the votes. I don't know that's the case for all the nominees. So I think Pete Hegseth is 14th, and then you look at RFK when he goes. I think how they perform is really going to go a long way into suggesting whether or not they have the support to actually get confirmed. So that's one thing I note as you read these things.
And as you kind of handicap that, who stands out as maybe the most at risk of not getting the nod?
At this point, I think RFK Jr. For Health and Human Services Secretary, somebody that's probably I'd watch to see at risk. Pete Hegseth looks like he's done a little better in terms of shoring up support. Again, how he performs in the hearing is going to be important. Tulsi Gabbard for Director of National Intelligence, somebody else to watch. Trump's labor secretary pick, sort of interesting. Definitely signed more with unions, so I'm curious to see how she fares when she goes up. Former representative from Oregon, I believe. His name is escaping me at the moment, but I'm not sure her pro-union stance, how that's going to play well with Republicans, but maybe the offset with some of the Democrats, I'm not sure. So there's just ones I sort of keep an eye on initially.
Excellent. Well, in terms of the overall market, the good news is we entered the year with the percentage of issues above their 20-day moving average down in an oversold condition. That's resolved itself somewhat. We're certainly not overbought by any means yet, but starting the year off in a pretty good spot. January tends historically to be a good month for equities. My concern as we get into the first quarter, maybe into the second quarter, is the sentiment and really what took place at the end of last year, which is basically a capitulation on the part of most of the street, turning rambunctiously bullish is probably the right way to describe it. A far cry from where we started 2024, where there was still a lot of pessimism, and the Wall Street consensus forecast for the S&P was still well below what the spot market was telling us. So I think we'll have a correction. I think the year is going to be a decent year. You call it the low to mid teens, but I do think it's probably enhanced with an oversold condition that will help to ameliorate some of those sentiment extremes as we go. Again, seeing that weakness in some of these interest rate sensitive areas, that's a concern. To Neil's point about financial conditions, the triple B spreads, double B and triple B spreads are still in pretty good shape. So, the Fed might be looking at that and trying to thread that needle. We'll see how that plays out. But certainly there are areas of the market or the economy that are being impacted as viewed through the eyes of the market, and I think that's going to be important as we go forward. Neil, what do you have on the data front next week?
Well, it's going to be another big week. We have the inflation data coming out. So producer prices, consumer prices, putting those two things together will help us kind of set the table for the core PCE data. Look, we continue to be concerned about a passive tightening of monetary policy. Okay, and the reason being is, we continue to think that inflation is slowing down. Right. So the big news in the inflation data in the last month was just the drop in or the moderation in owner's equivalent rents. And that tends to be very sticky, OER primary rents. And if they're normalizing more quickly, that means that we're going to see inflation normalize more quickly towards the Fed's 2% goal. So if you have inflation slowing, and the Fed on alert for higher inflation and not easing as a result, that represents a tightening of monetary conditions passively, right? You're basically tightening by doing nothing, which then introduces additional risks to the economy. So we'll see how that goes. But that's kind of the concern right now. But if the consensus is right that you get a 0.2 on core CPI, that could mean that core PC comes in at 0.1. Right. So I just don't think it would take much. I mean, remember in December, the Fed actually raised the bar somewhat. Right. I mean, so in other words, you don't need that much on the downside surprise to kind of get them to change their inflation estimates lower.
Right. Right. Well, we'll certainly be watching the response from equities in this oversold condition. We also have staples are oversold, which is pretty interesting. So, the concern or the idea that the concern is around the economy, if that's, what part of this weakness is, certainly isn't founded because, staples don't tend to get oversold in those conditions. So I think that's certainly something to keep an eye on. Obviously, yields and where our yield impact model is pretty substantial in terms of the drivers of equities from here. Lower yields should help to propel us out of this oversold condition. A boost higher into the 5% realm will obviously have an impact in our view on the equity markets. A more sustainable impact will be if the 2-year yield actually comes down as the 10-year goes up. In other words, a steepening while triple B spreads start to widen out. That would be problematic for the markets historically. Well, join us again next week when we'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and hit that subscribe button if you're watching us on YouTube, where you can find us every week. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.